So today's kind of an exciting topic. We're going to be talking about year-end adjustments and transfer pricing tips for Malaysian taxpayers. And the reason we put this webinar together is because we want to give all attendees some tips on the importance of taking into consideration and monitoring year-end adjustments and the interlink between year-end adjustments and operational transfer pricing, which is looking at transfer pricing not only from a compliance point of view, but also from an operational point of view, which is a lot of the times overlooked. So we hope that by the end of this webinar, everyone is convinced that transfer pricing is not only about compliance, it's also about making sure that the operational aspects are properly planned and implemented. So before we enter into the detail, let me just give a brief 2-minute overview about our firm. Essentially, we specialize in providing transfer pricing advisory to multinational entities located in Asia and Southeast Asia, with 3 offices located in Australia, which is our head office, Singapore, and our Malaysian office. Between our 3 offices, we cater to the local taxpayers, but also to regional taxpayers to support them in their transfer pricing affairs in Asia and Southeast Asia as well. We are regular contributors to leadership journals such as the Institute of Singapore Chartered Accountancy Journal. We have also earned several awards as Best Transfer Pricing Firm of the Year, Asia Newcomer, and Asia Transfer Pricing Leader of the Year. For those of you, I see in the attendees some regulars, but for those of you who are new, let me just introduce the 2 presenters for today. So first of all, I will have with me Hon Chuan Tan, who is the director and technical lead for our Malaysian office with more than 10 years of experience advising multinational companies in the aspects of transfer pricing. And he enjoys being a pioneer of building up transfer pricing practices. Prior to joining Transfer Pricing Solutions, he helped with building up the transfer pricing for one of the leading accounting firms in Malaysia. Now we are fortunately enough to have him on board already for several years. And I will be co-presenting today with Hon Chuan Tan. My name is Adriana Calderon. I'm the Director of Transfer Pricing Solutions Asia and Malaysia and co-founder of our offices. I have more than 15 years of experience advising multinational groups in international tax and transfer pricing across 4 different countries. So with that, I will go into the agenda for today. Obviously, probably for those of you who have attended our webinars before will know that we love what we do. We love transfer pricing, and we keep doing these webinars very eager for people to pick up some good tips, and we will continue. This is like good news for everyone that we will continue in 2022. So we hope you all can follow us and join us also in 2022. So with that, let's talk about transfer pricing adjustments and year-end tips. So we will be covering 3 key topics today. First, we will talk about the transfer pricing cycle and its importance for adjustments and audits, because once taxpayer understands what the transfer pricing cycle means, then we'll understand the importance of succeeding in an audit when these operational aspects are sorted out correctly. Then we'll be talking about the type of transfer pricing adjustments in Malaysia. And last but not least, we'll be talking about some year-end tips and how to be audit ready. So with that, Hon Chuan, it would be great if you can explain to us a little bit of what it is the transfer pricing cycle, what is the importance for adjustments and audits. So the floor is all yours.
Thanks, Adriana, for the great introduction. Thank you guys for joining us as well. And as Adriana, you have mentioned 2022. So I'm like, oh, the time flies by so quickly that we actually have 2 more months for the year. And it actually has been a journey for those that have actually followed us throughout. And we have gone through theoretical part of the transfer pricing, and we figured that we want to share more on the operational side of things so that you guys know what should go on within your organization, right? So the biggest shift with OECD's base erosion shift, BEPS, is that transfer pricing needs to be addressed as any other area of tax, right? Previously, you guys will be more focused on corporate tax, direct tax, and now it's going to require additional education within your organization so that your key stakeholders are aware that there will be risk involved, and which needs to be managed as part of good governance for the group, right? So usually when managing the TP, a lot of companies focus on the compliance part of things, right? Your TP documentation, especially when transaction has already occurred and the books have closed, right, after your year end. However, the actual preparation for reviews and audits should start when the company actually enters or planning to enter into a verified transaction, right? So it's important to have that awareness and understanding that TP is actually a risk and it needs to be managed as part of your tax and international tax risk. Now, the best way for you to understand your TP arrangement is actually by going through the stages of TP cycles, right, which are listed above, and I'll go through it briefly later on the slides. So, which are planning and policies, price setting, transaction and journal entry, then testing and compliance, which is TP documentation, after which you have your monitoring, and lastly, you have your controversy and litigation, which obviously you want to avoid, right? So based on our experience, I'm sure a lot of you have started at the fourth stage, right? The testing and compliance, where you come to us and ask us, oh, how can you prepare TP documentation to test? So that's when your transaction has already occurred. And I guess that's mainly due to the lack of transfer pricing awareness previously. And what we have experienced is that there is a direct correlation between success rate of an audit and going through the TP cycles, especially from the planning stage. So hence it's very important to plan your transfer pricing arrangements.
Thank you, HC. I think that's a really good point, because as we will see in the second part, or at least in the monitoring part as well, you will give us some insight on what is understood as contemporaneous, which I think a lot of the times taxpayers are not aware what contemporaneous means in Malaysia. But let's don't get too ahead of ourselves. Let's start with talking and giving your perspective on tips when it comes to planning and policy. So I'm a multinational company, or I'm a Malaysia taxpayer, and I have decided that, or the business has decided that we have to implement or a control transaction. So what will be the first thing that you will advise taxpayers to look into?
The very first phase, planning and policies. I have actually emphasized it throughout the webinars that we have done so far. So in an ideal world, the starting point is to have a transfer pricing policy in place that actually sets out your transfer pricing framework as a whole in your organization, right? And some of the questions that you may ask yourself is, how does your company approach TP in general, right? Who is responsible for the TP arrangement, right? And then secondly, how is the arm's length standard applied, right? So this is where your benchmarking analysis comes in, right? Be it benchmarking searches or other TP methods to come up with the arm's length pricing beforehand when you enter into the transaction. And then whether the TP framework aligns with your business model or overall strategy of the business, right? You have your vision and mission of the business, whether the TP framework will go in line with that, right? So, and again, I would like to emphasize that TP planning is crucial, because if your TP framework is done properly, everything else should, by right, fall in place, as long as everything is adhered to. And obviously, communication is key, where everyone in your organization should understand there is actually a TP policy in place, a TP framework in place where it complies with your arm's length principle, right? That's.
Thank you, HC. And what about, okay, so going a little bit ahead and the stage where, okay, we already delineated the transaction, but now we have the transfer pricing conundrum, which is how do we go about the price? So what would be your views on that part of setting up the transaction?
Yeah, so I guess once you have at planning stage, you have performed the benchmarking analysis and you have actually come up with the arm's length pricing, right? The next phase is actually setting the price and contracts, right? If your TP framework is set out already, then the contract should be then formalized based on the arm's length price that has been benchmarked, as well as other terms and conditions that should be put in place. Right now, it will only be formalized when both parties signs the contract, right? You can't just put everything in place and no one agrees. And it's actually important to show the negotiation process between the parties, even though they are both their parties, brother and sisters companies, with evidence such as you have gone through your minutes of meetings, your emails between each other to show that you guys are agreeable with the terms and conditions and pricing between, and that you guys have signed the contract to formalize it. As these are actually sometimes requested by the RB as well. So it's good to have these evidence in place, right? And lastly, the contract is not just a document that you sign and then put somewhere else in the dark place to gather dust. It should be reviewed annually so that you can check whether there are any changes to the pricing or terms and conditions to see whether there are changes. If not, then that's fine. If there are changes, then you have to amend it accordingly so that your document actually remains up to date.
Thanks, HC. And okay, so I have my contract, I have agreed on a price, I have delineated the transaction. Then the following step is like, okay, do I just sign the contract and forget about it? Or what are some of the tips to keep in mind when it comes to actual implementation?
I guess that's where a lot of companies do today. This step is also equally important, right? Now that we have the form done, then here we have the substance that comes into picture, right? The implementation phase is to make sure that you have actually implemented what your contract says. So it ties back to your contracts. So based on our experience, more often than not, we see cases where they have all the nice contracts, all the documentation policies in place, the ribbon on top. But when you look at the actual implementation, the source data, for example, if I look at the invoices versus the contract pricing, there are actually a lot of discrepancies. The invoices actually charge this, the contract actually says otherwise, right? For example, like errors in markups. One is 4%, the other actually is 6%. Or errors in distribution margins, for example, where contract already sets out the fixed distribution margin that the distributor earn. But then when you look back, it's actually lower, higher, generally lower than what has been in contract. Well, this phase is actually important because RRB will come in and request for all these raw data, right? They have your contract, it's fine, but they also request for your invoices. They also request for your work papers, for your management accounts. They'll look at your TP policy and documentation, cross-check against each other, and see whether there's any discrepancy. This is their first point of contact. And obviously, their expectation is that your TP documentation and your source document should be consistent. And if not, you're essentially more or less providing them bullets to shoot back at you and ask more questions and investigate more.
Thanks, HC. I love the example of the distributor operating margin, because that's one of the most frequent mistakes that I think we have seen, which we will talk about when we talk about adjustments. So when it comes to testing, which is basically what everyone is probably more familiar with, can you just give us your views on some of the tips around testing and compliance?
So this is where most companies start with, right? So where it involves, mainly the preparation of the content or TP documentation per se, not content, that tests the pricing of the transaction. The idea is that this testing is performed at the time of the entering into the transaction, but of course, more or less when we come in prepared TP documentation, the transaction has already occurred, and we are testing on the actual margin or markups that were implemented before the income year, right? But obviously, some companies follow good governance and they perform the benchmarking analysis and documentation when they enter into the related party transaction and set the price based on the study to make sure that adjustments are generally not required. We have interviews with head of taxes where it's always good to know that nowadays doing actually nothing is no longer an option. Previously, it may be because the TP and the IRB may not be so aggressive towards less SMEs or medium tier companies where they only target multinationals. That's where money comes in. But now it's actually no longer an option, and compliance with TP and outstanding principle needs to be implemented within your organization. And another thing was one of the tax managers was explaining to them that when the IRB actually comes in, they provide them with the TP documentation, but they wouldn't know whether they were actually read by the IRB, but it sort of gives the IRB a sense of confidence and that the taxpayers actually knows about TP and they are actually prepared for any questions asked.
Thank you, HC. So I think one other thing to clarify here is like what is understood in the context of transfer pricing as contemporaneous. And the reason why it is important to understand this is because the contemporaneous concept actually differs from country to country. So in theory, we have that contemporaneous for some countries is what is called doing an analysis when entering into a transaction. And for other countries is after the transaction has happened, right?
Yeah. Which
is what we call reactive TP. Mm-hmm. But what is the view in Malaysia, HC, on this?
Well, I guess as Adrian has mentioned, the ex ante and ex post transaction, two approaches depending on the jurisdiction. In Malaysia, and I quote from the Income Tax Act, Transfer Pricing Rules 2012, not the guidelines, where it's stated that contemporaneous transfer pricing documentation means the TP documentation is brought into existence when a person is developing or implementing any control transactions, right? That's the first thing. And where in basis where of period of time, the control transaction is reviewed and there are material changes, the documentation is then needs to be updated prior to the due date of furnishing a return for that income year. So based on these two paragraphs, it specifically points to that ex ante approach where the IRB is taking a stance and require testing to be done prior or at the time of entering your related party transactions, right? So the awareness of contemporaneous is not there. I think a lot of taxpayers think that I prepare a DB doc and test the transaction after the income year, after it's done. But actually, it should be done before or during when you enter the DBI transactions.
And I think there is another aspect here which is of relevance, which is the fact that when you do contemporaneous documentation at the time of entering the transaction, and specifically before closing the books, you have more flexibility on whether the taxpayer has to correct something to meet the arm's length price, right? Which will be something that we will discuss during the in the following segment when we talk about transfer pricing adjustment. So maybe it would be great if you could tell us a little bit on the last part, which is essentially the monitoring. And the reason why it is relevant is because we tend to, this explains why do we need to do annual reviews. So it would be great if you can share with us some thoughts on the importance also of monitoring.
Yeah, I guess the annual reviews are most likely the most asked questions when we prepare DB documentation at the end of the engagement. Oh, how often do we review this? Are we doing an annual review, or are we doing it, or are we just gonna leave it as it is? And what should we do, right? Now, the first thing we need to know is obviously the biggest effort in preparing DB documentation is actually for the first year, right? Where it has to be prepared from scratch, right? Where all the information actually compiled into one, and then testing occurred during that time. Then, based on the TP guidelines, right, it specifically say that TP documentation should be renewed annually. I think they are referring to the benchmarking analysis, where the numbers should be renewed annually, that it should be refreshed every 3 years, right? So this is on the basis that if the business doesn't change, right, the expectation is that you update financial information of your comparable companies, and the rest of your document can remain the same, so that it can be as simple as adding an appendices to the original documentation, updating the financials, and then stating that no changes have happened in the business. Now, then new searches are actually expected to be performed every 3 years. So you have your year one, your initial benchmark search, year two, year three, the annual review, annual update, and then year four, then you have to renew your search, right? A new search should be updated, not updated, sorry, a new search should be performed. This is and to the existing search, and if no changes is in place in your business, then the search should be rather straightforward, because business says the same. But if there are changes in your business, it's always good to actually first reassess your transfer pricing position within your organization. We look at your TP documentation and see what needs to be updated, and then how much needs to be changed, right? And obviously, you update, you refresh the benchmark search at the same time, right? That's where the question comes in, like, every 3 years. So basically now you know that the fourth year you need to actually update, get the new search performed, right? So now that we have gone through the TP cycles, I guess I know that from planning to testing and to lastly the monitoring. Adriana, now that I think the audiences will be able to happy to hear you speak, it'd be great if you could share with us what are the types of adjustments that can happen in Malaysia.
Thanks, HC. I guess The point here is we all know that in the real world, maybe not everything goes up like as planned. And the question is, what can I do if I do have to do some adjustments, or what do I do if I actually didn't implement the prices correctly? So I guess, first of all, I think it is important to understand what is a transfer pricing adjustment. A transfer pricing adjustment really is an adjustment to the price on a transaction to basically reach the arm's length price agreed in a control transaction with a related party. So in Asia, maybe we are not totally familiar with the concept of true ups and true downs, but essentially the adjustments can be driven by either the taxpayer or the tax authority. So the taxpayer can adjust, also known as true ups or true downs, the price to reach the arm's length price agreed. And we also know that the tax authority can adjust the transfer price in the context of an audit. So then let's go through first what are the options available for the taxpayer, and then what happens when the tax authority does seek an adjustment. And with that, it's good to see it in an example so people understand what we're talking about. Just to put the two comments, the slide before in context, if I have an entrepreneur located outside of Malaysia that pays a service fee to a company C located in Malaysia, and we have agreed that that service fee is going to be a net cost plus markup, and we are going to agree that company C is a limited risk services or a share service that is going to earn a markup of 5%. So my end of the year result should be a net cost plus a 5%. But we all know that the success of that 5% markup is driven by the company, in this case, company C, accurately budgeting for its expenses during the year. So they know the periodical invoice that they need to issue to the entrepreneur to reach that 5%. But as I said earlier, not everything goes to plan. So company C can have expenses outside of the budget, or can have variable expenses that are sometimes hard to control. So the taxpayer, meaning company C, can monitor the result on a periodical basis to ensure that that 5% is achieved at year end. Now, this can be more tricky with certain industries, especially when you have a physical trade of goods and imports or exports involved. And maybe with services, it can be slightly more easier to do it. The point is that company C can do a true up or a true down during the year if it needs to achieve this 5% markup. So a true up will be if the result is looking like a net cost plus 3%, so I need to true up 2%. A true down is that I am reaching 7%, but I need to reach 5%. Without a doubt, we all probably can guess now that true downs adjustments can be a bit more tricky to justify, because in theory, what I'm doing is reducing my assessable income. Whereas true ups might be less of an issue with the tax authorities. So then the question is, what options or what do company C has as available tools to adjust to that 5% if it's not reached at year end? So the first thing that the first adjustment that any taxpayer has available is year-end adjustments before closing of the accounts. which involves basically making sure that the actual result, that closing of the accounts, is in line with the arm's length price. And the reason why you will do the adjustment is because the actual result differs from the arm's length price. Obviously, as I said earlier, it can be a true up or a true down. And obviously, depending on the materiality of this true up or true down, but I think nevertheless, based on what we have discussed earlier, very important to have the transfer pricing analysis and contemporaneous documentation to support the adjustment. These true ups and true downs are generally performed before closing of the books, because once the books are closed, then you generate the management accounts and then the audit starts. And auditors will be very particular about allowing true ups or true downs after the audit has started. So nevertheless, obviously, IRB can still carry out audits and make any transfer pricing assessment, because the true up or true down at year-end is really an internal management tool to reach the arm's length price. And obviously, as I was saying earlier, one thing to watch out for is for the interaction with customs and indirect tax, especially for transactions that have an impact or have also customs or sales tax embedded in it, because then you will have to do some adjustments, because obviously customs and sales tax is driven by the value of the service or the goods, which is why a lot of the times if companies do have resources in-house, they may end up doing more frequent review. Some companies, if they have a full-fledged TP team, may do reviews monthly. Others will do quarterly, and others will do at a minimum twice a year.
Right. I think this is what we have mentioned earlier, right? Regarding the year-end adjustments, performing the adjustments, where I think communication is key. So the person performing the adjustment will need to know the pricing policy in the first place, right? What's the pricing in the contracts? What needs to be done throughout, through down, so that it needs to be communicated throughout, not just the finance manager, but also your accountants as well, knowing what to do at the end before closing of the accounts. So, but what happens if the company actually close their books, and are the avenues that they have in relation to adjustments?
Well, then Malaysia has the possibility to do voluntary disclosures. Voluntary disclosures is essentially the possibility to adjust prior year prices in relation to transactions with related parties. And in theory, this can be also upward or downward. So in the audit framework in Malaysia, we have the requirements to do these voluntary disclosures, which involves preparing a form together with the estimation of tax payable adjustment. And we also, the taxpayer will also have to provide some documents associated with transfer pricing, obviously the transfer pricing documentation, the analysis, organizational charts, with roles and responsibilities, the basis for the adjustment, and how the transfer pricing and comparability analysis has been performed to support that adjustment. So obviously, it can be a bit, it can be a big decision for the taxpayer, because it involves disclosing a lot of information to IRB. So a lot of the times the taxpayer will be in a two mindset of, do I do this or do I play catch me if you can't game? So I think that really depends on the risk appetite, but it's good to know that this option is available, but it has some pros and cons that the taxpayer will have to assess. I guess, yes. I don't know if you have any other points here on the voluntary disclosure.
Yeah, actually, I wanted to add on this, where this is not to be confused with the back in 2019, they actually have a special voluntary disclosure program by the Minister of Finance, where they allow them to voluntarily disclose with a reduced penalty, right? So I guess now that that period has already lapsed, right? Those that have also joined that program previously will also need to reassess that nothing has changed during the time when you have joined that special voluntary disclosure program, so to speak, right? So I guess from here, we all know that there are risks involved in voluntarily disclosing your position, and as you said, company may not want to go to this path and would like to go to that ever famous path, the wait and see path. So actually, what are the implications if they were to wait and see, Adriana?
Yeah, so I guess I forgot to say something, HC, to the audience, that we have a Q&A chat. We already have a question which will be addressed at the end, but please, we do have also a Q&A box where everyone can post their questions, and we will address them once we are done with our webinar today. I guess we have also the tax authority adjustments, right? Which is basically the adjustments that are sought by the tax authority if they are of the view that the taxpayer is not in compliance with the arm's length principle. So this usually starts with what is called a desk audit, where the IRB will request some information from the client, and particularly expect the client to provide the transfer pricing documentation that is contemporaneous within 14 days. And if they want to pursue an adjustment, then it will be a transfer pricing adjustment that is the outcome of a TP audit. I guess it is important also to keep in mind the penalties involved, because in an audit case, I think the worst case scenario is when the tax authority will seek for a transfer pricing adjustment and the taxpayer has not prepared transfer pricing documentation, because now in Malaysia, we have also a non-compliance penalty, which can be between 20,000 to 100,000 ringgit plus, which we don't have there, imprisonment of 6 months for the director. So there is a big responsibility for the director of the company to be fully compliant. And to be quite frank with you, HC, probably you and me are already paying attention to our own transfer pricing, because we don't want to be in imprisonment for 6 months. So we also have to have our documentation, contracts, etc., and operational TP in place, because we're a multinational company as well. And obviously, the audit penalty in the event of non-documentation can be quite high, which is about 50%, plus the non-compliance, plus the 5% surcharge. Then the second best scenario is where there is TP documentation that maybe is not, it might not be fully in accordance with what IRB believes is the arm's length price, but the taxpayer has done the due diligence, and it submits within 14 days. So in this case, obviously the taxpayer will not be subject to non-compliance, because in theory it has the documentation, but it might be subject to a penalty of up to 30% of the TP adjustment. And in the case of the voluntary disclosure, if the taxpayer comes forward to amend its transfer pricings and maybe they don't agree with IRB, the penalty will be less hefty, because it will be 20%. And then obviously, if there is a desk review where the taxpayer has TP documentation that is comprehensive, as an IRB agrees with the position, then obviously there is non-compliance penalty and there is no penalty on any TP adjustments, right? So then just to summarize really what we have in Malaysia is one option is true ups and true downs before closing of the books, for which contemporaneous documentation at the time of entering the transaction is key. Or we have the possibility of voluntary disclosures, but obviously the taxpayer will have to assess the pros and cons. And we have the catch me if you can, a scenario which is if the tax authority comes and seeks a review, then you can reduce the exposure by having at a minimum TP documentation, because then you wouldn't be subject to a non-compliance penalty. And with that, HC, maybe I pass it on to you back on our last topic of today, which is what are your audit ready and year-end tips for our audience today?
Yeah, I guess I'll go through it with an example, but once as we have gone through the cycles and the adjustments, you by now you should know that what's important, right? So in this example, we have a group that has a distribution arm in Malaysia, where the Singapore sells the products to Malaysia, and then the products are on sold to the third-party customers, right? It may look like a simple example, but then the question, then I would like to raise as to what are the disputes that we have experienced so far, what to do so that you can be audit ready, and whether in what circumstances that your customer actually perform any adjustments, right? Linking to the examples, I'll go through the common areas of disputes. Next slide. Okay, so first up would be structures, transactions with lack of substance, right? If you look at that example, distribution, it may be incorrect characterization, right? Depending on your transfer documentation analysis, whether the distribution characterization is indeed a distributor. Are they a distributor, or are they a wholesaler? Are they a retailer? Or depending on the arrangement, it may be completely different from what a distribution is, and it may be a procurement service provider, so to speak. So it depending on the characterization. So that's one of the disputes that you have. And then the next would be, the substance wise, right? In Malaysia, are there substance over form in terms of paid counts? Are they doing what they're doing, responsibilities over the contract? Then obviously whether there are any contracts in place, right? So that's one of the common disputes for substance over form. And then the next one is incorrect pricing, right? This is where we also experienced so far, where you have, as I explained earlier, you may have a contract in pricing on one hand, but then your pricing, implementation pricing is different from the other, right? If those companies that have already incurred transactions after they have closed their books, or they have not done any planning in the first place, then are the prices or markups or margin supported by the benchmarking, right? Have you guys performed benchmarking and come up with a arm's length interquartile range and see whether that pricing is correct? And then others are whether pricing is actually correct in your contract, right, in your form in the first place. And then there are also another scenario where, yes, you have a contract in place, but then due to the period that's passed, and that contract may have been 5 years before, and no monitoring or no renewal to the contract pricing has been assessed, and hence you have been following the contract pricing for X period of time and has not been reviewed, and then the tax authority comes in and go through your pricing, and you think that your contract pricing is actually arm's length, but when the IRB were to come in, prepare benchmarking, and the latest figures may have deviated from the price 5 years apart due to commercial environment or your industry position, which may compromise your pricing as a whole, right? So that's your incorrect pricing. Then the third one is recurrent loss makers, right? So this is where whether you have to reassess your company's financial performance as to whether are they actually consecutively loss making, right? So if you are consecutively loss making and you have high value of related party transactions, this is actually a huge red flag to the IRB, where they will be able to adjust. They'll be looking at your related party transactions and come up with a benchmarking and loss making. They may adjust your pricing upwards, your margin upwards, where you're bringing from a loss-making position to a profit-making position. That disparity will be enough to compromise your company's position, right? So when you're actually loss-making, you have to make sure that you substantiate your loss-making position and make sure that you properly justify why your company is loss-making in the first place, right? And make sure that it's not because of the related party transactions, right? Then fourth one is choices of comparable companies. Well, IRB, I think I've seen the FAQ in IRB in 2018, where questions were asked to the IRB whether they use secret comparables. Obviously, the answer that they gave was we don't use secret comparables. But based on our experience, they actually do use comparables where those comparable companies are not available publicly, and that's where obviously will need to justify from your perspective and from IRB's perspective as well. And in Malaysia, local comparables are 100% more preferred in Malaysia. So when you perform benchmarking, make sure that your comparables are all in Malaysia. And if not, you will need to have a really good reason why you broaden the regional scope to search for other comparables in other jurisdictions, right? And the tax authorities will generally aim to actually reject comparables that are loss making, so that obviously to pull up their own benchmarking into a cutoff range. Then second last, what point in arm's length range is acceptable? As you all know, we come up with a arm's length interquartile range, which means a lower quartile to upper quartile, the 25th and 75th percentile with a median point, right? But based on our experience, the IRB is very much prefer the median point. They're actually aiming at the median point. And during an audit, if your margin actually falls below the median point, but still stay within the interquartile range, they may actually adjust your margin upwards to that median point, even though you're in the arm's length interquartile range, so to speak. If any of your margin actually deviate from the median that you have performed benchmarking on, then it needs to be explained and substantiated why your company is actually below the median range, even though you are in the arm's length interquartile range, right? Then lastly, TP adjustments, as Adriana has gone through the process, it's generally allowed before closing of the books. Once you've closed your books, there are a lot of implications that are put in place. And then you have to be cautious with your indirect tax and your custom duties, custom tax as well. And retrospective adjustments can be very challenging and may give rise to double taxation. Domestic is fine, but double taxation with other jurisdictions.
Thank you, HC. I think in the context of that distributor that we were looking earlier, the true ups and true downs can be done to reach the operating target, the operating margin target, right? Mm-hmm. And if it's not achieved, then the best time to do it is before closing of the books. But the only way you will know whether you are reaching your target operating margin is by having proper data of distributors in Malaysia, which is where the benchmarking comes into place. Okay, so why don't you just tell us a little bit about, in your experience, what is the common information requested during audits and reviews? And if I am a tax manager or a finance manager, what should I keep in my records to explain a future audit?
Yeah, I guess it depends on what stage the audit is in. I actually have experience where a client was actually raided by the RRB without any notification, early notification, and they just go into the client and actually gather all the information, all the work papers, all the financials, and then bring it back to their office. But generally, before a desk audit occurs, they would have sent you a letter, M&E letter, to request for certain information. The first one will definitely be the transfer documentation, and then they'll ask for your agreements, your contracts. They look at your organizational chart, which should be in your TP documentation, your raw data, invoices, supporting your verified transactions, sometimes job descriptions of your the department within your organizational chart, and then obviously the support on calculating your pricing and basis for the price of the transaction and the formula behind your price setting. Right? These are the common information requested. Sometimes when they have requested these, then they will ask for further information later on.
Thank you, HC. So maybe before we move to the questions, what would be your key tools or tips from today?
I guess for those that want to take one thing away, I think TP planning. I always emphasize TP planning as the key, especially to be successful in an audit. If you look at what we have gone through the TP cycle so far, you know now that if you actually prepare a TP planning and you know your outstanding price, you already know what's going on throughout the process, and your TP documentation will follow that outstanding pricing. When you test it, you're testing the same benchmarking. So all in all, we are safe, unless there are certain circumstances where, you know, now that we are in a COVID situation, we have to further explain more on why certain sectors or certain segments are actually performing poorer than others, right? That's where TP planning comes in as well. When COVID comes in, we already know that it will come, and we already know that there are expectations from the IRB for you to explain your pre-COVID status, your post-COVID scenario.
Yeah, and I think obviously one thing that I always call is reactive TP, which is after the transaction already happened. And not only after the transaction already happened in 1 year, is the transaction already happened 5 years back, and you still have open years that the tax authority can come and review, and then you are carry on over and over a mistake, creating a snowball effect. This is another reason why doing reactive TP really decreases the chances. If there is a concern with the price, it really decreases the chances of the possibility of being successfully defending in a TP review, right? And I think obviously we have said through the webinar that the best time to do any adjustments is really in the form of true ups, true downs before closing the books, obviously bearing in mind that you may have to take care of audit or other aspects of tax and customs as well. I think with that, we have some time for questions, which are one is in the chat, and there are a few others in the Q&A. And for those who want to pose more questions, feel free to post them in the Q&A chat. So we have the one in the chat Okay, there are more than one in the chat.
Mm.
If we were to perform adjustments on the pricing through true ups and true downs, then the company should issue debit note, credit note for transaction which takes place for the entire based on the adjusted pricing. You want to take that, or you want me to take that? Like, or we both?
You can take it first.
Okay, so yeah, in theory, you can do it between a debit and credit note. I think another way that you can do it is also, for example, if you're doing, it also depends on your invoicing cycle. So for example, if you're doing monthly invoices and you need to catch up on a shortfall at month 10, then you can also just try to compensate or increase the price in that invoice rather than doing a credit note or a debit note, because you still have one more invoice to go, so that invoice can help you to catch up on whatever shortfall you have in the price. So yes, it's possible to do it via debit or credit note, or also via end of year invoices that might be pending. But again, as we said earlier, bear in mind that you need to first understand what is the implication from other tax point of view, and address that. There is another question.
Yeah, I think that's a very good question.
Yeah. Sorry?
Yeah, I was going to say that it was a very good question because, it depends on when you actually invoice, right? It's always good to do it not at the end of a year, but if you have a monthly invoice, then you can actually, slowly rebalance your adjustment to your pricing and margin. So not like at the end, but yeah.
Yeah. So when we make upper on that one, TP adjustment, we usually adjust the cost of goods sold. Do we need to inform customs, and how do we do it? I think yes. How would you have to do it in Malaysia? I think that's probably something that is outside of what we can advise on, but I'm guessing that you may have to talk to a custom expert to understand how can you adjust any declarations if needed to. In the case of cost of sales, you have to probably do adjustment on the import declaration potentially.
Yep.
There is another question that says, what database are typically used by tax authority to prepare sets of local comparables?
I think,
yeah, you go.
Oh, okay. For the IRB, IRB here, they use different sets of database. They don't have a specific set of database for them to search for comparables. And as you know, they do have access to the SSM database as well, where they extract most of the information. And we are in the view that the IRB would accept the database that we use so far. So I think SPIDA was one. SPIDA is one that we are using Thomson Reuters. So as long as the process taken, undertaken to actually search for comparables, and they have gone through the process and the accepted and rejection criteria, those are actually generally accepted by IRB.
Yeah. I think specifically in Malaysia, there is quite, and funny enough, right? This question of the database comes across a lot, but it's interesting to see how in majority of audits that we have faced, the last thing that the tax authority asks is, what database did you use? Like, we have never been asked such a thing. We have always been asked, can I access publicly the information? What was the process undertaken for doing the benchmarking? What was the reasons for accepting? What was the reason for rejecting? But I can confidently say that not one tax authority has asked us ever, what is the database that was used? So, which is quite, interesting.
Actually, on that database part, right, that's another question and answer was, we understand that IRB prefers local benchmarking during TP audits. Is this stated in any updated TP regulations or guidelines, right? So actually it is, well, it's not specifically spelled out, But if you look at the guidelines, if you look at the appendices, they will actually go through the process of the benchmarking, so to speak. And in one of the mapping, it will show you that to go through Malaysian directories and to have Malaysian comparables as well. It's in the, I'm not sure what para it is, but it's in the appendices if you want to refer to it in the guideline.
Oh, okay. Give me 2 seconds because so that's the one question that was in the okay, so I'm gonna say that we did. There is another question in the chat that says, will the IRB disclose the basis they applied in the comparison with the TP pricing? For example, will they disclose the company they took as an example for comparison in the audit?
They will. That's where the discussions comes in. So they have their comparables, you have your comparables. Then it's up to us to defend your position, to look at their comparison, the company they have selected versus what they have selected. And then we sit down and discuss who are the most comparable in your circumstances.
There is another question that is actually in the question and Q&A. I have another company B, where they undertake my project maintenance job, but due to we are not able to register company B with my customer, I have to collect the maintenance order on behalf of company B. Question here is, can I give a PO to company B for the exact value to bill me back? So I'm assuming that the related party of company B is a related party, and that's why it collects in its behalf. So I think what you have to keep in mind here is, if you're making the argument that it is a collection on behalf and there is no value added by the related party that collects, then potentially passing the PO back to back makes sense, right? But if you're going to argue that the related party does provide or does add value, maybe because it manages the customer, then that will give you a basis to charge something on top of back to back. So it comes down to what is the nature of that collection of payment on behalf. And if you're of the view, but there is just not value add, it's just literally kind of renting the name for collection purposes, then maybe doing it back to back is correct. Let me just see. I think we have time for one more question, which is back-to-back charges. Is it considered a related party transaction, like petrol and handphone bills charges, or any back-to-back charges?
Oh, well, I mean, if there is a transaction in place, the rule of thumb is when there's transaction between two clients, I mean, two related parties, that will be deemed as related party transaction, and you will know when that disclosure comes into your audited accounts. Yeah. And when the auditor comes and asks you, and they will disclose it as a related party transaction.
Correct. Okay, so with that, I think we can close our webinar for today. So as you all know, we have an assist taxpayers with preparation of documentation, planning, compliance, master file, regional transfer pricing documentation, Malaysian local file, and Malaysian benchmarking. Obviously, we have a very resourceful YouTube channel where we actually upload a lot of videos with lots of tips and educational aspects. So check it out, and when you can subscribe. And our last webinar of the year will be next week, which we will be talking about the new e-tax guide on transfer pricing in Singapore. And after that, we will be taking a break, HC, after how many webinars? more than 15 webinars, more than 20 hours in Zoom, talking to everyone and talking to clients and potential clients and people who want to learn about TP, which is great. And then we will be back in 2022. Stay tuned with that. And if you want to reach us out, feel free to write us an email on services@transferpricingsolutions.Malaysia or MIY. Thanks everyone for attending today. And I think that's a wrap.
Have a good year and
for 2021.